Hello everyone, and welcome to what is probably our last lecture in this semester in financial risk management. We've now arrived at section in chapter 7, in which we want to discuss several different hedging strategies for some selected risk types. So what we are basically doing is we are taking the instruments we've seen in chapter 6 and we are trying to use these instruments to hedge risk types we've seen in chapters 2 and 3. In many cases, these will be equities, equity investments, stocks, and we'll hedge these positions using futures and options. What is a hedge in this context? It's usually the combination of a financial derivative and a long and short position in the underlying, and by combining the underlying with a corresponding derivative, we get a position that has a lower or should have a lower risk than the initial position. So you will shortly see how this works. We'll start out very simply with hedging with futures. So we'll add a future to an existing spot position. And you will see how actually, even with a one-to-one short hedge, we can eliminate all risk. So that's the first example. It's called a short hedge. And we'll use a one-to-one short hedge, meaning that we add one derivative, one future, to one underlying. Later on, we'll see you can also do a 1-to-2, 1 and 3 short hedge. This is a one-to-one short hedge. Some notation: S is the time at which the short position, in this case the future, was established, and T is the time at which the futures contract is settled. Capital T is the maturity of the future. KT is the price of the spot security, the spot investment, and FS is the price of the futures contract. So first, we neglect any interest on in and outgoing payments in the margin account. We simply concentrate on the prices of the spot position and the underlying and the future. So what is the profit or loss of the one-to-one short hedge? Well, let's go through this. Initially, we've bought the underlying, so it's minus KS. So this was our initial investment minus KS. In point T, at point T, we can sell this spot position, so we get KT. So KT minus KS, okay, this here, this is, let me just fill this out. This is the profit or the loss from the underlying investment. And correspondingly, we have gone short in the future. So actually, we've received FS, and this is not working. Sorry. So actually, we've received plus FS, and at maturity, we have to settle this, so it's minus FT. If you rearrange this a little bit, you get minus FT minus FS. If we now switch again the spot price, no, the future price to the other side and rearrange this a little bit, we can see it's actually FS minus KS minus FT minus KT. And this then gives us basis minus basis. So actually, the profit and loss position of this one-to-one short hedge is the difference in the current and the future basis. And the basis, if you remember this, for a futures position or a forward, the basis was the difference between the future and the spot price. Now, before maturity, the basis, BT, is stochastic. You remember that it actually, we have the spot price can go up, and spot and future price will converge to each other, but at some point here or here, the difference, the basis between the futures and the spot price will be stochastic. Hence, if we want to close our position before maturity at small t, The perfect hedge may not be achieved because we still have this difference in the basis. At time capital T, however, this here becomes B capital T. So this actually becomes 0 because of the convergence of the futures to the spot price. So that actually the profit and loss from our hedged position is the initial basis we could observe on the market. So if BS is slightly negative, this will be the price of our hedge. Now note that the short hedge with futures completely offsets both price, losses and gains. If the underlying goes up €1, if it goes down €1, the hedging instrument, the future, will go in the other direction, and in exactly this amount. So you don't have any chances of making a profit or a loss via the 1-to-1 short hedge. Now, why would you do this? Actually, it's quite simple. In many cases, you're not trying to speculate with this, but you're trying to hedge a position for example, an underlying you need. So what you could do is actually, if you see, well, I'm in need of, let's say, steel, or I'm in need of oil, and you see a price that is acceptable to you, you can simply hedge this position using a 1-to-1 short hedge. And you can fix the price using the future. So this is the profit and loss for the 1-to-1 short hedge. As you can see, we have the short future, we have the long investment in the underlying, and if the basis is here, this will be our hedged position depending on the spot price, and it will be constant. The profit and loss will be constant at BS. Okay. If the underlyings of the future in the spot position, if they do not match perfectly, we get what we call cross-hedge risk or cross-hedging risk. Meaning that, for example, you have an investment in the stock of BMW and you only get a future on the stock of Daimler. Then the underlyings will not perfectly match, they will be different, and you will get what we call cross-hedging risk. Now, in contrast to a short hedge, you can also do a long hedge. So what is this for? It's used to hedge a not yet existing but planned spot position. So if you haven't bought this but you're planning on buying the underlying, this could be the case actually when you know that, for example, in 3 months you need more steel. So for this purpose, the futures contract is bought and you go long in the future. And then for the 1-to-1 long hedge, the profit and loss function is given by, again, we are planning on doing this. So this is the future profit and loss of our future investment in the underlying. This is the long future. And it gives you the exactly opposite difference in the basis. So it's not BS minus BT, but it's BT minus BS. Again, before maturity, the hedge might not be perfect. And at maturity, capital T, we get minus BS as the profit or loss. Now, you might think from this, actually from this or this is nice. If I only see a difference, or if I only see a non-zero basis, I can always make a profit. I either do a 1-to-1 long hedge or a 1-to-1 short hedge. Problem is, it seems as if you can earn a free lunch, as if you can either earn BS or minus BS, depending on whether it's positive or negative. Problem is, this will be this risk-free profit, which it seems to be. This risk-free profit will be eaten up by transaction costs. So in reality, you will probably earn less because you still have transaction costs. Now this is the perfect long hedge. If you have the go long in the future, so long future, short in the underlying, and then you get this hedged position. Okay. Now let's analyze this hedge a little bit closer. We are considering the case of a short hedge at time t equal to s. We have a portfolio of n shares of the underlying with price ks, And in addition, we have X futures. So a variable X of futures that each refer to one unit of the underlying. And we can then restate the profit loss position of the overall portfolio by, we have N underlyings, N times the profit or loss from the underlying investment plus X times the profit or loss from the futures investment. Again, we rearrange this a little bit. We have N times KT minus KS minus X times FT minus FS. And the futures spot and futures prices KT and FT, they are stochastic. Thus, GT, the profit or loss, is stochastic, and we can calculate an expected value and the variance. Wir können also von dem Gewinn oder dem Verlust aus dem gehedgten Portfolio können wir den Erwartungswert und die Varianz bestimmen. The expected value is given by N times, and in this case KS and FS are observable, they are known, they are deterministic. KT and FT are stochastic, so it's actually N times the expected value of KT minus KS minus X times the expected value of FT minus FS. And the variance as well, you can calculate the variance. This is a linear combination and two stochastic random variables. And you need the covariance between KT and FT. Okay, so far so good. We can now determine the minimum variance hedge. That is the hedge that the number of X, the number of futures we need to reduce the variance of the profit and loss to zero. In other words, if we are able, if we reach zero, how many futures do we need to reduce the risk to zero? So we have a hedge that guarantees minimal fluctuation of the total profit and loss position. Very simple. You take the variance, take the first derivative with respect to X. We get 2x variance of ft minus 2n covariance. We set it equal to 0, solve for x, and we get n times a certain beta factor, kf, for the German Korrekturfaktor. We still have that in German. We should change this probably. And what is this? This is the covariance between the spot price and the futures price divided by the variance of the futures price. So actually this is a beta factor. So what we can see is in the one-to-one short hedge we used one future for one underlying. Now if, and only if, the correlation in a sense and the beta factor between the futures and the spot price, if this is not 1, then we need to adjust the number of needed futures to make a perfect hedge or the minimum variance hedge. So you can see if the underlying and the spot security, if they have a correlation and a beta factor that is not perfectly 1, then we have to correct for this. So X star, the ideal number, the risk reducing and minimal risk number of futures, is not simply equal to the number of underlyings n, but if the correlation, the covariance between these two, in this what's the word for Korrekturfaktor in English? This adjustment is not 1. We need to correct for this correlation between the futures and the spot price. Now, also see that a reduction of the risk to 0 is not possible. The remaining risk still amounts to n squared, the variance of the spot price, times 1 minus the squared correlation between the futures and the spot price. Or if we take the volatility, it's n times the volatility and the square root of this expression. Now in practice and in reality, the inequality rho is larger than 0, is regularly fulfilled. We will always have a correlation that between the futures and the spot price that will be larger than 0, that will be positive. So if we know that this actually is larger than 0, we can also form the following inequality: n times sigma times the square root of 1 minus the correlation is smaller than n times the volatility of the spot price. So you can see that we can actually, and we will do this later on, we can bound the variance or volatility of our hedged position. So the perfect hedge only works if the future and spot values are perfectly correlated, meaning that the future price is given by the cost of carry price. And for the hedging period being equal to the maturity, the one-to-one hedge is perfect. So what would happen? Let me show you this again. Use the red one. Now assume future and spot prices are perfectly correlated, meaning that rho is 1. Then we have 1 minus 1. This vanishes, becomes 0. And actually we have this one. So this is okay. Actually this disappears as well. And we have volatility of 0. But this only happens if the correlation between spot and futures price is perfectly 1. Meaning what? Spot price goes up, futures price goes up by €1 by €1. This is only the case if the futures price is given by the cost of carry price. Doesn't need to be the case in reality. It will be close to the cost of carry price, but the correlation will never be perfectly 1, at least not in reality. Now, if we take the number of futures needed to get to the minimum variance portfolio or minimum variance hedging position and divided by the number of underlyings we're trying to hedge, so X star divided by M, this adjustment factor, beta, this is called the hedge ratio. We can also write the hedge ratio as the correlation times the ratio of the volatilities of the spot and futures price, and this is the hedge ratio. So the ratio of the needed futures to hedge N underlyings. Okay, now let's calculate the expected value of the overall hedged position. Again, by using the hedge ratio, so the expected profit or loss is given by N times the expected spot price minus the paid spot price minus N times the adjustment factor times the difference in the expected and initial futures price. We rearrange this a little bit. You can see this becomes N times the beta times Fs minus Ks minus beta times the expected value of the futures price minus the expected future spot price. At maturity, we then get N times Bs, that is, we have risk-free profit or loss depending on the initial basis when we bought the spot investment. And for any t and the beta factor being equal to 1, however, we have the following, that the profit and loss at any time t, not just capital T, is given by, actually it's the expected value, it's no longer stochastic, and it's N times Fs minus Ks minus expected value of Ft minus expected value of Kt. So a positive basis that does not widen results in a profit, whereas a negative basis that does not widen results in a loss. If the basis changes, we might also make a profit or loss, and that's what you can see here. So if these differences, if they do not change, or if they change, and if they are positive or negative, we get a profit or a loss, respectively. Okay, so this is very simple hedging with futures. Now, futures are linear instruments. You can see that under model assumptions, when you have perfect correlation between the spot and futures price, actually the spot price goes up by €1 and the future goes up by €1. So it's natural to say, okay, let's use a one-to-one short hedge. Underlying goes up €1, future short goes down €1, and you have a perfect hedge. How does it work with options? So we'll consider options now, and we'll start with a one-to-one put hedge. It consists of hedging a position of N securities of an underlying by buying an equal number of puts on the same underlying. So we are going long in the put. And then the value of this position in capital T is ST, we can sell off the underlying, plus PT, we get the payoff from the put, and we have to add our put contract to the position in T0, so we have to buy the put for a price P0. Okay, so we've bought the put, we sell the put, we sell the underlying. The price, the payoff for the put is given by the maximum of X minus ST, or 0. And if we now combine this, you can see that the value is given by X minus the put price for, make this English, for ST smaller than X, or ST minus P0 for underlying prices that are larger than the strike. So that's the hedged position. If we want to look at this in more detail, you can see that actually this is the linear asset, the stock. If the stock goes up by 1, the position, the portfolio goes up by 1. The put option, if this underlying price changes, the price or the value of the put at maturity changes. And if we now, let me zoom into this here, what happens is, initially, we would have had this. Now we have to buy the put. This leads, if we only buy the put, if we were to waste this amount of money, we would get this function. But what now happens is that at the strike, let me use this line here, now it would be like this. But because of the put option, we have a hedging effect that leads to this. So let me delete this for a moment. So actually, we are here now, and we would continue if we only had the stock. But because of the hedging effect of the put, we get this line. So this is the advantage of the hedge. This is the advantage of the hedge, because we will, for these extreme losses in the stock price, we will be compensated via the option contract. So this is the advantage of the hedging instrument. Okay, so that's the one-to-one put hedge. Very simple. You have a long investment in the underlying, and you add one put. This is the profit function, assuming that you still have the buy, the underlying. So this only, actually this is this one here. This is this plot, and you only have to subtract S0. So it will probably look like this. And you can see it's exactly this. So you have to actually subtract S0, and you get the profit and loss function of the whole put, the one-to-one put hedge, that is including the price you had to pay for the underlying. Okay. The one-to-one put hedge results in an asymmetrical profit loss function at the end of the term. If we had alternative strike prices, you will have a trade-off between an increased hedging against losses and reduced participation in gains. It's clear from this plot that you're wasting some opportunities. That is, for example, here, if the stock price goes up here, with the one-to-one put hedge, you will get this profit. If you didn't enter the put contract, you would get this profit. So this is actually the cost of the hedge. So that's the price you have to pay to be safe in this region here. Where's my cursor? Yes, in this region. So that's the price you have to pay. With a put hedge, hedging can also take place during the term. And for American put options, the hedge is X minus P0. For European puts, the hedged amount is not X minus P0, but X discounted minus P0. So you have to include this term for the discount factor, but it stays the same. What are the premises of the put hedge? You need corresponding puts. Again, if you want to hedge the stock of Daimler, you shouldn't use an option on BMW stocks. So otherwise you will get a cross-hedge risk. If the hedging horizon is capital T, puts with at least this term must be available. Subsequently, if you don't have enough puts, you need to buy additional puts, and this will lead to increased costs, additional transaction costs. And positional restrictions and exercise limits must be considered. This is theoretical. In practice, in reality, a company would be very careful when dealing with financial derivatives. It's usually only banks, insurance companies, financial institutions, and very large industrial companies that are even allowed to trade in financial derivatives. Usually, small and medium-sized companies will not engage in derivatives tradings because it will expose you to regulation, and it will expose you to supervision by the financial supervisor, and small and medium-sized companies usually do not want this. Insurance companies and banks are also, they are supervised, of course, and sometimes they cannot engage in too much derivatives trading. So there might be positional restrictions and exercise limits. So if I say, well, I have an underlying and I want to do a one-to-one put hedge, this means that the put hedge is possible from a legal standpoint, it's possible from a regulatory standpoint, and it's possible based on the availability of option contracts, and you don't have a cross-hedge risk. Okay. Now let's take this to the next level, the 1-to-2 put hedge. So we change the hedge ratio and we're using 2 puts for 1 underlying. Actually what happens is, and I can make this in short, actually we've seen that if this is the linear asset, well, it should be a linear function, sorry, what happens is that with a 1-to-1 put hedge, we have some costs and we get this hedging effect. If we have a 1-to-2 put hedge, actually, let's use a different color, we have additional costs, but we have a higher hedging effect. If we were to use a 1-to-3 put hedge, maybe, you can imagine where it goes from here. More costs because we have now to buy 3 puts, and the effect will be more extreme, like this. So that's what you can see on this slide here. Sorry, cursor please. Okay, this is the 1-to-2 put hedge. We have 2 puts. So this is the price for the first put, like this, and this is the price for the second put. And instead of going something like this, we now have this line here. And if we have very extreme changes in the underlying price, we are also able to profit from these extreme changes, but this only comes at additional cost for a second put. So the 1-to-2 put hedge allows us to hedge the portfolio value, again in capital T, in the amount of x minus 2 P0. And compared to a 1-to-1 put hedge, the cost of the hedge doubles, but we will also benefit from extremely negative changes in the underlying price. And the strategy of hedging via a 1-to-2 put hedge is therefore particularly suitable when you expect strongly fluctuating, not rates, but prices for the underlying. However, if the volatility of the price is low, so if we only expect, let me see, if this is the current, where's my cursor here? If this is the current stock price and we only expect the price to change in this interval, you should stick with the 1-to-1 put hedge. Yeah? So if you expect low volatility of the price, a 1-to-1 put hedge would be more advantageous due to the lower costs of the hedge. Now, opposite direction, the 2-to-1 put hedge. So we are using 2 underlyings and 1 put. Could also have called it a 50% put hedge. It's a 2-to-1 put hedge. The profit function is given by this expression, and as you can imagine, it's the other way around. It's less costs and less of a hedging effect. It only goes down like this. That's a 2-to-1 put hedge. Okay. Next, a 1-to-1 covered short call. This is a hedge where we are using an underlying and we go short in a call. So this here was long underlying, long put. This was a long underlying, long put. So what we are doing now is we are going long underlying, short call. So the profit function is now based on the payout profile of a call in a short position. And we also sometimes use the synonymous term call hedge. It's a little bit misleading as losses in prices are only hedged up to a certain amount. And the covered short call is only recommended in a market with low volatility. So this is the covered short call. As you can see, again, we have the stock and we go short in the call, and what we get is we are driving up our losses in this amount, and at this point our profits are bounded. So we cannot participate in extreme profits, and that's the price we have to pay. So we have opportunity costs at the right hand side, and we have slightly lower losses on the left side. So that's why you shouldn't call it a call hedge. It's not so much that we are hedging, but this rather is, it's a covered short call. It looks a little bit like an insurance contract. You know? So you're reducing your losses and you're foregoing on those chances for a profit. Next, we have a collar. The collar consists of holding the underlying, purchasing a put, a long put, and selling a call. So long put, short call, and underlying. Basically, it's a combination of the covered short call and the put hedge. And what you can expect is it's exactly this. That's why it's called a collar. We are bounding our losses using the long put. We are bounding our profits here at the start, and in between we have only the costs of the hedge. If P0 is C0, so if the price of the put is the price of the call, then we are calling this a zero cost collar, which in this case is, line here. It's very nice. It bounds the losses. Then in the middle it has the same profits and losses like the stock, and then again it's all bounded below. That's the profit function. It only means that you have to add the investment in the stock, and then we get the collar. So the collar will be here. We have to buy these underlying for S0. We have to buy and invest in the options, so we get C0 for the short call. We have to buy the put, so it's minus P0, and that's your collar. The collar can also be created using this combination of a 1-to-1 put hedge with a short call, or a covered short call with a long put. And as we can see, the collar limits both the profits and the losses. If also the two strikes, X1 and X2, if they are the same, we can calculate the final value using value is strike X minus P0 minus C0, and compound it until capital T. Now, a risk-free position then results at option maturity, so that actually for arbitrage reasons, it has to be equal to the amount S0 invested at the risk-free rate, and then suddenly and surprisingly we get the famous put-call parity. You might have seen this in other lectures on derivatives, and this is a very simple way to show the put-call parity. Meaning what? On the left hand side you have C0 minus P0. This is maybe not so interesting at first sight. Yeah, it's the strike, no, sorry, the current underlying price minus the strike discounted using R and capital T. But in other words, you can also write this in this way. C0 equals P0 plus S0 minus X1 plus R taken to the power of capital T minus T, sorry, okay. And this is why it's called the put-call parity. Now, in an arbitrage-free market, that's the requirement here, of course, if you have the put price and you have a call on the same underlying, you can calculate the call price from the put price via the put-call parity. So a call and a put give you exactly the same amount of information. If you have one, if you have C0, you can calculate P0 and vice versa. So that's why the put-call parity is so important and so famous. Okay. Now, what to do when you want to hedge heterogeneous portfolios? If the portfolio consists of different investments, it can be hedged against price losses in two ways. You can purchase puts on the individual portfolio components, very, very expensive, and you can purchase options on share indices. Note that the degree of protection when using puts on stock indices is lower, but of course it's cheaper than the use of individual puts. Now, all this hedging becomes quite difficult and tricky when you are looking at a portfolio, because due to transaction costs, you don't want to buy one put for each investment in the portfolio. But on the other hand, if you don't hold a share index, if you have a portfolio that only resembles the index to some part, you need to do what we call a beta correction. You need to correct for the fact that your portfolio does not perfectly track the index. And then this beta correction corrects the number of index puts that are required to hedge your individual portfolio. Okay. Then, now, next, let's move to options and risk-free investments. We are now combining options and fixed interest securities, like, for example, a bond or a zero bond. Now, we have an initial capital, K, is invested to K1 in the safe investment, the risk-free investment, and K2 in the long call. And K2 means N times C0, that is, we buy N calls. And the final value of the assets in capital T is, of course, given by K1, the investment in the risk-free rate, compounded using I, the interest rate, plus N times the payoff from the long call. If we buy N puts instead, we get the same here. Only difference is that, of course, we now have the payoff profile of the puts. So we have N times the maximum of the puts, or N times the maximum of the calls. In both cases, our wealth is hedged downwards to K1. And one can speak, and we call this a cash and option hedging strategy. Now, this means that you take part of your money and you invest it in the fixed interest security, and not everything is lost in the option contract. So that's a rather very simple way of hedging your investment. You don't go all in the option contract, and you put some money in the risk-free investment. Now, we can also do a synthetic put. We consider a European put with a price determined according to the Black-Scholes model, and the delta of the put is given in the Black-Scholes model with minus standard distribution function value of the standard normal distribution at minus D1, and the value of the put can be represented by an investment of amount X times exponential function and so on in the risk-free investment, and a short sale of N of minus D1 shares of the underlying. And thus we get a synthetic put. We can replicate this. How? We can replicate we can synthesize a put by taking an amount of money and putting it in the risk-free investment and going short in the underlying. And this is a synthetic put, and you can then use a synthetic put to do a one-to-one put hedge. Now, why should we need this? Well, in some cases, we don't have traded options for an underlying. And if you don't have an option traded on the exchange for such an underlying, then, of course, you would use a synthetic put. You would go short in the underlying, if at least short selling is allowed, and you take a certain amount of money and invest it at the risk-free rate. And then, if Black-Scholes model is true, and we have the assumptions of the Black-Scholes model fulfilled here, then you can synthesize a put. Let ST now be the value of the portfolio to be hedged in T, and PT the Black-Scholes price of the synthetic European put. Then we can synthesize this. We get a synthetic hedge. ST plus DT gives you this expression here from the Black-Scholes model. And the one-to-one hedge is thus also synthetically derivable. So we take a fraction, QT. Obviously, this is calculated from the expressions from the Black-Scholes model. We again have n of d1 here. And we invest this in the portfolio, and the complement 1 minus QT is invested in the risk-free investment. However, of course, if Black-Scholes model assumptions are not fulfilled, this doesn't work. This only works if all the assumptions of the Black-Scholes model are fulfilled, and this, of course, is a pretty hefty assumption. Okay. Next, we can also combine options. So we take the 4 basic positions in options, put, call, short, long, and we get different trading strategies. For example, a vertical spread, a horizontal spread. And these are speculative strategies with reduced price risk, as both profit and loss opportunities are limited. So, for example, a bullish call vertical spread. That is, you speculate on increasing stock prices. You purchase calls with a lower exercise price and a simultaneous sale of the same number of calls at a relatively higher exercise price. What is the maximum profit? That's the difference between the exercise prices minus the difference in the option premiums. The maximum loss is the difference in the option premiums. For a bearish call vertical spread, you speculate on falling underlying prices, and this consists of a long call position with high strike price and a short call position with a low strike price. You can also combine puts and calls with identical exercise prices and terms, and we get a long straddle or a short straddle. So a long straddle is buying calls and puts, short straddle is selling calls and puts. The long straddle corresponds to a speculation on high price volatilities in the underlying, and for a short straddle, the chance of profit is limited to the total of the option premiums. However, at extremely decreasing or extremely increasing prices in the underlying, you have a nearly unlimited loss potential. We can see this here. This is the short straddle. So if the stock goes down, well, you are actually making a profit in this area here. If the stock becomes worthless, your maximum loss will probably be here. But if the stock price increases dramatically, this goes down, and it can go down extremely. Now, imagine you are a derivatives trader and you're speculating. And unfortunately, you've speculated on the Tesla stock. Or let's make it even worse, you have a short straddle on GameStop. Now, if the GameStop stock, is it GameStop stock? Yes, GameStop stock. If the GameStop stock goes up to here, well, your loss actually is extremely high. So you can see why option contracts and options in general have a negative reputation, because you can, of course, do hedging. Hedging is perfectly fine. Hedging is actually good in the sense that you are minimizing your risk, but you can also go all in and you can build a position that is extremely risky, as you can see from the short straddle. Now, again, a short straddle on a GameStop stock, complete disaster. And you can combine puts and calls with different exercise prices, but the same term, which will give you so-called strangles, a long strangle and a short strangle. A long strangle, the loss is limited to the total of the option premiums paid, and you have almost unlimited profit opportunities with sharply falling or sharply increasing prices, and the other way around for the short strangle. And a variation of a strangle, as well as straddle positions, is achieved by combining different numbers of calls and puts. And then these are long strip and long strap strategies. Okay, so this is a long strangle. It's not a straddle, but it's actually a strangle. You can see that the losses are bounded, and here you have unlimited loss potential, profit potential, but of course this is much lower than the initial stock investment, right? Okay, and then the long strangle, also the same. This is a variation. For example, you purchase the call option with a low strike price, and you purchase a put option with a high strike price, and this is actually a combination. And there's a typo here, it's Rudolf and Schäfer, not Schäfer. Okay. Then we are closing in on the end. We have a long strip, two puts with the same exercise price, same maturity, purchased for each long call position, and this is profitable after large price movements, and this overweights price declines. Okay, next page. So this is the long strip. It's more extreme and slightly different than the strangle. And we have a long strap, two calls, same exercise price, same maturity, purchased for each long put position. And this is profitable again after extreme price movements. And this is the long strap position. Okay. We also have a butterfly spread. This is a strategy where the wings of a straddle are limited by additional options. And you can imagine how this looks like. Instead of this, here's something like that. Oh, something like this. We limit the loss potential. We purchase two calls and sell two calls. The first call is bought in the money. The second one is bought out of the money. Now, we haven't talked about in the money, out the money, and at the money. What are these? Well, what are in, out, and at the money options? Well, imagine you have a current stock price as 0, and K is 100. And this is the strike is 100, and we have a put option, meaning that we can sell at K equal to 100. Okay. Go to the next line. Now, if the current stock price is 100, this is called an at the money option, or just ATM, at the money. If S0 is 80, this is called a in the money option, because on the market we can sell for 80, the strike is 100, so if we were to exercise the option right now, we would make profit. So it's in the money. And if you can imagine where it goes from here, if the stock price, the current stock price is 120, this is an out the money option. And vice versa for a call option. It would be the other way around. So we buy a call in the money and the second one out of the money. And in addition, two calls are sold at the current price. So this is a long butterfly. And the aim is to generate premium income. And this is a butterfly spread. Okay. Now you've seen all these different option strategies, and what you can now do is actually, and what is done by structured finance, in structured finance and in investment banking, the trading departments in investment banks will take these instruments, they will combine them, and they will form new contracts. These are called certificates, Zertifikate, structured products, financially engineered products. These will be new financial contracts, and the investment bank will then say, okay, we are structuring this and we are buying derivatives, short positions, fixed income products in wholesale, and we can offer these structured products to our customers. So by means of combinations of spot and derivative transactions, you get new financial contracts, and this is done, for example, via duplication. And these are structured products. Ich sage das nochmal kurz auf Deutsch, weil ich glaube, das ist an der Stelle noch ganz wichtig. Wenn Sie sich gefragt haben, was macht denn eigentlich eine Investmentbank? Eine Investmentbank hier an der Stelle im Bereich strukturierte Produkte und auch Derivatehandel macht im Grunde genommen das Folgende. Irgendjemand kommt zu Ihnen als Investmentbank und sagt, ich hätte gerne ein Finanzprodukt, das mir aus welchen Gründen auch immer die Zahlungsreihe minus 100, ich zahle 100 jetzt dafür und ich bekomme dann 2, 4, 8, 16, minus 1, 2, 3 plus 5 oder so. Dann würden Sie jetzt, das ist ein sehr konstruiertes Beispiel natürlich, aber Sie würden dann an der Stelle ja sagen, das ist kein Bond, das ist keine Anleihe, das ist keine Aktie, das ist kein übliches Instrument, das am Markt gehandelt wird. Was könnten Sie jetzt machen? Sie könnten sagen, ja, dann hole ich mir doch einfach einen Zero Bond, irgendwie, also sagen wir besser minus 10, sagen wir mal irgendwie plus 16, so, das könnte also der Zero Bond sein. Und dann sage ich minus 50 und dann kriege ich hier irgendwie, was auch immer das für ein Instrument ist. Und ich hole mir dann 5 Wertpapiere und wenn ich die dann alle kombiniere, habe ich im Portfolio genau diese Zahlungsreihe. Heißt, ich zahle 5-mal Transaktionskosten. Dann werde ich es nicht mehr machen. Und ich blähe meine Bilanz völlig unnötig auf. Das, was ich jetzt machen kann, ist, ich kann zu einer Investmentbank gehen und sagen, liebe Investmentbanker, das läuft natürlich nur im professionellen Bereich. Das machen Sie nicht als Kleinkunde, sondern das ist im institutionellen Bereich der Fall. Sie gehen zur Investmentbank als Firma und sagen, ich hätte gerne diese Zahlungsreihe. Und dann sagt die Investmentbank, gerne, können wir Ihnen anbieten zu einem Preis, ich sage jetzt mal, von 102. Ja? So. Wir bieten Ihnen diesen Zahlungsstrom an, für 102. Macht jetzt hier in dem Fall natürlich mit den Zahlen keinen Sinn, aber trotzdem, die Bank sagt Ihnen Preis 102. Und dann schließen Sie einen Vertrag ab mit der Investmentbank. Und die Investmentbank macht das natürlich nicht nur mit Ihnen, die macht das mit allen. Und dann kann es sein, dass die Investmentbank noch nicht im Portfolio sieht, ja wunderbar. Das eine Derivat habe ich links, bin ich da short gegangen, rechts long. Das heißt, meine Position ist völlig geglättet. Ja, die ist völlig gehedged, links 2 Euro rein, rechts 2 Euro raus, ich habe in Summe 0, ich verdiene hier Provision und das war's. Und das ist letztlich dieser ganze Bereich Financial Engineering, Structured Finance, Structured Trading in Investment Banking, dass dort letztlich hier strukturierte Produkte strukturiert werden und dann angeboten werden. Mein Lieblingsbeispiel dafür, wo Sie sowas mal wirklich sehr plastisch sehen, ist im Film Big Short, wenn Christian Bale, glaube ich, zu JP Morgan geht und sagt, hier, das sind ein paar Kreditportfolios, das sind irgendwelche Anleihen, ich will mich dagegen absichern, ich will einen CDS haben, ich will einen CDS-Kontrakt haben mit Ihnen und will mich gegen den Ausfall dieser Portfolios absichern. Und dann sitzen da 3 Quants, die sagen dann, ja, nee, können wir machen, wie hoch? Ja, so irgendwie so und so viel 100 Millionen, ja, nee, können wir machen. Unser Preis sind irgendwie so und so viel % Aufschlag. Und dann sagt er, ist okay. Also das sind strukturierte Produkte, das ist Structured Finance in der Hinsicht, dass Sie also hier natürlich, das Ganze wird nur spannend durch Derivate, ne? Dass Sie Derivate und andere Produkte miteinander kombinieren. Und wie das dann funktioniert, sehen wir jetzt. So let's first look at a so-called discount certificate. With a discount certificate, the buyer receives the value of a fixed number of shares at maturity. However, payment is limited to a maximum amount of C. So this is a so-called cap per share. And the value of the structured product is thus systematically below the value of the share. This is why it's called a discount certificate. And what we get is we are being paid n times the minimum of the cap or the stock. And this means that you can split it up into the stock investment and the minimum of C minus ST or 0, or this is actually ST minus the maximum of C minus ST and 0. And suddenly you can see that such a discount certificate is nothing but then a stock and a short call on these puts. Thus, the discount certificate securitizes a covered short call. Now this seems weird. Why does it securitize a covered short call? I can always do a short call. No, the covered short call are two legal transactions, the stock and the option. The discount certificate is just one product. It's one contract. So that's why the discount certificate securitizes a covered short call. Das Discount-Zertifikat verbrieft den Covered Short Call. Beim Covered Short Call haben Sie zwei rechtliche Transaktionen. Sie kaufen das Underlying und die Option und gehen da short. Bei dem Discount-Zertifikat haben Sie nur ein Wertpapier, das Sie kaufen. Deswegen ist es eine feine Unterscheidung, aber genau da spiegelt sich wieder, was die Investmentbank denn eigentlich liefert. Die macht aus zwei Wertpapieren ein Wertpapier, nimmt dafür eine Gebühr und sorgt aber natürlich in ihrem gesamten Portfolio dafür, dass das Ganze jetzt nicht in eine heillose Spekulationsblase irgendwie ausartet, sondern dass man hier natürlich auch Skaleneffekte nutzt, dass da viel getradet wird und dass man das Gesamtrisiko für die Investmentbank eigentlich auch relativ im Griff halten kann, in dem Bereich zumindest, wenn man es auch beherrscht. Okay. Garantiezertifikat, guarantee certificates. The buyer receives the underlying at the maturity, provided that the underlying price is above a fixed guaranteed amount. Same thing as a capped discount certificate, just the other way around. So, as you can see, again, the guarantee certificate duplicates the underlying and a long put. So, again, the underlying and a derivative contract. Equity-linked bond. An equity-linked bond, in this case, the issuer of the bond, can repay either the nominal value or a predetermined amount of the stock at maturity. So in contrast to a convertible bond, the issuer thus has a conversion right. This is why it's also called a reverse convertible bond. Sie kennen das vielleicht, ein Convertible Bond. Ein Convertible Bond ist eine Anleihe, bei der Sie als Käufer das Recht haben, entweder die Anleihe zurückzubekommen, also das Geld, oder eine festgelegte Anzahl an Aktien. Und da machen Sie natürlich das, was für Sie vorteilhafter ist. Beim Equity-Linked Bond ist genau das Gleiche, nur der Unterschied ist, dass jetzt nicht der Käufer, der Halter des Bonds, sondern der Emittent das Recht hat, entweder N zurückzuzahlen oder eine Anzahl an Aktien. Und deswegen steht dann natürlich hier nicht Maximum aus N oder den Aktien, sondern das Minimum. Und again, we can see that this is probably linked to a derivative, yes. We divide this cash flow into its components and we can see the minimum of N and N times ST is and so on and so on. So what we see is this is capital N minus N times the maximum of this. So the cash flows can be split up into Z, 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 Z plus N. This is a coupon bond minus N times the maximum of capital N divided by small n minus ST and 0. So this is a regular bond and a short put on these stocks. If you combine this and securitize this, you have a so-called equity-linked bond. Okay, so that's it. You've now seen very basic hedging strategies. You've seen most of the important option strategies, even for speculation. You've seen how these can be securitized, usually by investment banks, and then, of course, used for investing, used for hedging. And this is what is frequently done in financial risk management. You're using these instruments and you're hedging against the risk that stems usually from a long position in an underlying. Okay, If you have any questions, please stay in the Zoom room. Otherwise, thank you for attending. Thank you for listening and watching these videos. And good luck with the exam. Thank you.